Good afternoon, everybody. My name is Eric Chaput, Business Advisor at the World Trade Center, Winnipeg. I would like to begin by respectfully acknowledging that this webinar is coming to you from Treaty 1 territory, traditional territory of the Anishinaabe, Cree, Oji-Cree, Dakota, and Dene people, and on the national homeland of the Red River Métis. Thank you for joining Small Business Tax Planning, which will be presented by Peter Moreira. A few housekeeping information before we start. Please send all webinar questions directly through the chat box at the top of your screen, and Peter will try his best to answer as many questions as possible toward the end of today's session. For all logistical questions, please send directly to the chat box and I will answer the question as soon as possible. You will also receive the recording and the slide of this presentation within the next week. All right, let's kick off this webinar. I would like to introduce you to Peter Moreira, who has over 15 years of professional experience in financial management, economic development, business consulting, planning, and teaching. He is a chartered professional accountant, holds an MBA graduate degree, and a Bachelor of Commerce. His experience includes key roles in business, startup, expansion, and successful success of numerous business in Manitoba. This expertise is supported and enhanced by a previous role as a CFO with the province as an assistant deputy minister. In addition to his consulting practice, Peter shares his knowledge and experience as a continuing faculty member of the University of Winnipeg in the Business and Administration Department and is regular session leader in the professional education program with the CPA Western School of Business. All right, welcome, Peter, and let's begin this webinar.
Hey, awesome. Thanks for the intro, Eric. Hope everyone can hear me okay and see the screen. I see some nods, so that's a good sign. Okay, so thanks for the introduction. So we've done this once before last year, and it sounds like it was quite successful and valuable in terms of the information that was shared. So that's why we're all here again today. So thanks, World Trade Center, for putting this together for everybody. Certainly the world and area of tax and tax planning for small business owners, whether you are a sole proprietor or if you're incorporated, is certainly complex, and there's a lot of things to think about. In an hour, we can only cover so much. So I've tried to put together a bit of a mix of some useful items that we can cover. The first little bit, we'll talk about some of the tax credit programs that are available, offered by the province of Manitoba. Some of them are a bit specific depending on your activities, what you're doing as a business, but they can be quite valuable from a tax perspective. And then we'll talk about some of the key items that are usually on business owners' minds. There's been some changes to the capital cost allowance program in terms of updates of values. We'll talk a little bit about what's happened to the federal tax tiers so that even if you are a sole proprietor or if you're owner of a corp, depending on how you take income, that's going to affect you. Certainly a big one in everybody's minds is the CPP and the current recent enhancements, a few other tax planning considerations, and then the new Canada Dental Benefit Program, which is important for small business owners to think about for yourselves and for your employees, because there's some additional reporting requirements required. Okay, so the first from the tax kind of credits pool here are items that I want to talk about that's available with the province is the SBVCTC, which kind of sounds like the beginning of a rap song when you say the acronym, but it's the Small Business Venture Capital Tax Credit Program. And we do a lot of work with small businesses in Manitoba to help them take advantage of this tax incentive. It's not an incentive for the business itself, but this is an incentive for investors in your corporation. So if you are starting up and you're trying to raise capital, this program is very, very valuable and is not terribly difficult to get set up for. So what it does is it gives the investor into your company a non-refundable tax credit against Manitoba taxes payable, and the value of the credit is quite good. It's 45% of the value of the investment. So let's say you're trying to raise capital for your business and you're want to take on an investor or another owner in your corp, and they have $20,000, let's say, to invest in your company. Then what'll happen? They make that $20,000 investment. And then when that investor, they can be an individual or they could be a corporation, when they file their tax returns, they would get 45% of that level of investment back as a credit against their Manitoba taxes payable. So on a $20,000 investment, that's $9,000 back in tax credits. And the reason that that's really valuable is that when you think about it, that puts the net cost of their investment at $11,000 as in that particular example. So it's a great way for an investor to de-risk when it comes to investing in small business in Manitoba, because it lowers their actual cost of investing in the corp. And it's great for companies and businesses in Manitoba to raise capital a little bit more easily. So the investment can be in common or preferred shares. There are some minimums, so minimum investment of 10,000 per investor. And really some of the steps or the hurdles of getting approved for this is the company does need to be pre-approved with the appropriate Manitoba office, and the application, the program information is available on Manitoba's website. But really, if you're a new startup, just confirmation that you're a new startup, either from your lawyer, your accountant, professional that's supporting you. What's important to keep in mind is some of the minimum requirements of how to qualify. So the company that's raising the investment, so your company does need to be a CCPC, and that means it's a Canadian controlled private corporation. So what that means is your company has to be controlled by a Canadian tax resident. It's not an immigration question, it's a tax residency. And then the business has to be conducting an active business. So you can't be a business that, let's say, is renting out commercial property or renting out property that's passive. So you have to be using your assets of the business for active business purposes, and that's how you're generating your revenues. And this next bullet is really the main hurdle, is you have to have, as the current owner, have to already have $25,000 of cash equity already invested in the company. So if you are a brand new startup or thinking of starting up, then you yourself have to have injected $25,000 into the company as a start to be able to qualify. To be small business, by definition of this program, revenues of less than 50 million, less than 100 full-time employees, not a reporting issuer. That means you're not a publicly traded kind of thing on a stock exchange. And then the third bullet there, at least 25% of employees reside in Manitoba. I really like this one. People often think that you have to have all your employees here. This is really good, especially nowadays with, remote work options. Many businesses in Manitoba are hiring individuals that may be located in another province. So to ensure compliance, only 25% of your workforce has to reside here in Manitoba. And there is a limit of 10 million of the company, and each investor can invest a max of 500,000. One of the other things to keep in mind, there's a couple of restrictions on what you can do with the funds. That's just not on the slide here. So when the company receives the funds, the investment into the corporation, those funds have to be spent in Manitoba. So you do need to use the dollars that you've raised to purchase your supplies or equipment in Manitoba, pay Manitoba wages. You can certainly still have activities going on outside of the province for sure, but the dollars that you've raised through this program have to be used to acquire capital or pay for expenses in Manitoba. And the other condition or requirement is that you can't pay yourself back whatever you've invested in the company with those proceeds. So it can't be a way for you to raise capital just to pay yourself back, let's say a shareholder loan or money that you've invested in the corporation. So it's definitely a great program to help attract some capital that provides a really great tax incentive for your investors to facilitate that investment. There's a similar program. I won't go into the same level of detail. It's the CEDTC, so the Community Enterprise Development Tax Credit. Very much mirrors the small business venture cap tax credit. So the rates are very similar. It's a 45% tax credit. depending on 45% tax credit on the investment dollars raised to the investor. There's no minimum investment on this one, and what distinguishes this program from the first one, the small business, is that this is for cooperatives, like community enterprise type of businesses. So if you've incorporated under the Cooperatives Act, you can still incorporate under the Corporations Act, but your business has to be a community enterprise type of business. So great if you're operating and running a business in that space. Still some great incentives available there as well. Any questions so far before we kind of carry on? Sometimes these generate this SBBCTC program generates some questions. Okay, awesome. Oh, is this only for startups? No. So you do not have to be a startup to qualify. You can be already in business. So when you are a business that's already existing, what they would probably ask for is your most recent financial statements or the last 2 years, copies of tax return showing that it's been filed in good status, just to confirm active business activity. If you're a startup, the reason that when I mentioned earlier that they would ask for, let's say you're a professional like your accountant or your lawyer to confirm that you're a startup, is remember one of the conditions that you have to be an active business. So that's really the element of confirming that status. But yeah, if you're an active business, absolutely no problem. If the shareholders raise the capital, does it apply to them as well? I am pretty sure the answer, I will double check on that one because I actually haven't seen that yet, but that's a good question. So I'll double check on that when we take a quick pause. I think the answer is probably yes, but I will double check. Okay. If your business is doing anything in interactive digital media space, there's a really great program here as well. So a similar idea, it's a tax credit, but this is a refundable one, which is great. And this is for the company itself. So if your business is offering services or products in this space, you can get up to 40% on of a tax credit on your qualified labor expenditures, some of the money that you spend on marketing activities, distribution, in the development of your product. So what does interactive digital media mean? It can't be just developing an app. It has to be something that the user, your ultimate customer, engages with. So video games, simulators, learning products that are multipath where there requires participation from the client. So it can't be just something where they just kind of watch. It has to be some interactivity involved with the digital product. So to qualify again, has to be a Canadian corporation, permanent establishment in Manitoba. Still that 25% resident requirement for employees. If you are less than 25% of salary and wages for Manitoba employees, then you can still qualify for a smaller amount of the credit, as long as as long as you're doing $1 million at least in labor expenses annually, which is can be a bit of a hurdle if you're a small business. This program does require pre-approval as well too, so it's important that if this is something that does sound like you would qualify for, that you do get involved with the application process earlier on than later, and to get that pre-approved by the province before you really start planning on being able to get the credit. A couple of questions. Yes, I do believe the webinar has been recorded. Can family members be investors? Yes, I have seen that as a for sure. Yes, so family members there's no, I haven't seen a related party issues with investors. And then any kind of business. So it has to be an active business. So you can't be running, let's say, a business that is considered passive. So if your business is primarily derived of earning rental income, that would not qualify. Hotels. There's also other exclusions like professional corporations, so lawyers, accountants, corps, those kinds of things would be excluded. But if you're like an active business, retail services, other types of services, manufacturing, production, those kinds of things are all okay. Salon, yes, yeah, that would qualify. Good. I'll keep checking back. There's also, this one is not a tax credit, this is a grant, and I know that this is a tax planning piece, but I think since, the bulk of you are in the small business space and small medium enterprise in Manitoba, this is a really great program that I think more and more companies need to know about in Manitoba. So Manitoba has what's called Innovation Growth Program. It is a grant, so it's a cost sharing grant that helps you commercialize new innovative products or processes. So it's really great because it's often very expensive to develop a new product or to develop a new process or a new way of doing things. And so the idea here is that this grant program helps businesses accelerate and to get their product to market that much more quickly. So it is an application-based grant program. There are, I believe, 4 rounds per year. So the province will take applications, they'll review the applications, and then they will award the grants to a number of companies on each round. But it is a cost share, 50-50 cost share. So the program will grant up to $100,000. So you would need to spend $200,000 to get $100,000 back. And the application process, you would outline what the costs are that you're expecting to develop that product. And the program will have some specifics around what qualifies and what doesn't in terms of types of expenses. But for the most part, labor, expenses to develop the product, materials, product development. It's really anything that is legitimately a cost in the prototyping, the development of your product or your service would be eligible under the cost share program. So who's eligible? Have to be for profit. So unfortunately not available to not-for-profit organizations. Again, permanent establishment is here of the businesses here in Manitoba. This one, the requirement is a little bit higher for where the employees are located. So 50% of the salary and wages have to be to Manitoba residents. Small business in this context, or small to medium-sized enterprise in this context, is 15 million of revenues or less, and still less than 100 full-time employees. And then as well, the owner has to demonstrate that they've invested $25,000 into the business already. Through equity contribution or maybe funding past expenses to wherever you're at so far in the business. The exclusions are ineligible or similar, so no professional practices. Again, lawyers, accountants, the type of thing. The can't be a business that's primarily earning passive income, so no hotels type of thing, or that type of passive earning rental income is, I guess, really the best way to think about it. Obviously, they have to make it clear no crown corporations, municipalities, so no levels of government would be able to apply. And it is also intended to support businesses that don't qualify for other types of financial assistance through the province. So if you are getting other grants through the province, they may come back and say, once you've exhausted those programs and still need more, you might need to come back to this program. It's not that it's considered one of last resort, but if there's other programs that you are able to access first, you get pointed to them first. Real estate agents. Real estate agents, I think if you are like a sole provider, would be a no. But if you are starting a real estate practice, maybe. But then you would remember the criteria is that this is to fund the development of a new product or service. So if you are a real estate firm, like let's say you got a franchise or a Remax location or something like that, if you need to spend money to develop a new practice or process or new way of doing things that is considered innovative, then yes. Can these programs be combined? For example, the digital one that is structured as social enterprise. Yes. So you could, let's say you do the community development, the community enterprise development tax credit program to raise dollars for investors, right? And to get that tax credit for them. But if, and as a business, you are doing what you're doing qualifies for the digital media, interactive media tax credit. Yes, you can put those together. Great questions. Some examples of the type of costs that you would incur under, commercialization activities. So building your and scaling your prototype for sure. Certainly any costs incurred on testing, trial runs. Also, any costs that you would have to incur to certify or register intellectual property. And there's a lot. If you are in this space where what you're doing is you're registering intellectual property, there's a lot of phenomenal programs out there right now to cover the costs, some of the costs of registering your intellectual property. North Forge, for example, has access to dollars through the federal government, as well as IRAP program through the National Research Council. So there's some money out there to help with those things that I'm sure WTC can help you help put you in touch with those resources. But I work a lot in this landscape right now, and I don't think I've seen this much money available for IP and innovation, intellectual property and innovation in quite some time. So if you are developing something new, reach out to your WTC person to help learn some more about those programs. Other commercialization activities that are important to remember too, like if you have to spend some money to, market development or expansion activities, there's some room for those types of costs in there. So traditionally marketing costs are kind of viewed as soft and don't usually qualify, but under this program, there would be room for some of those. And then costs for scaling up your business to grow, to be able to handle these new markets. Okay, any questions about some of those tax credit programs before we move on? Hi, Lisa, did you have a question? Okay, maybe not. Okay, so let's talk about some of the more tax type of things that are going on. So the CCA program, nice to see some increases here again. For many years, these limits were left alone, but given that we have been in a pretty high inflationary environment over the last couple of years, the federal government has done a good job of raising some of these limits. So we saw some large increases in 2023, and we see some more in 2024 now, which is really great. So the capital cost allowance program is the depreciation model when you file your taxes, and whether you are a corporation or a sole proprietorship. If you have tangible capital assets, so machinery, equipment, vehicles, those kinds of things, you can depreciate them, and that depreciation is an expense against your taxable income. Oh, there was a question. Are formulas intellectual property? Yes. So if your formula is unique and you want to patent it and register that intellectual property, yes, that is definitely a good example of intellectual property. Formulas, processes, ways of doing things, a designed product, those types of things are all IP. So yes, the CCA program, so that's our mechanism of depreciating. And so this is really important for taxpayers because you want to make sure that you are taking advantage and structuring yourself in a way that takes advantage of these programs. So if you have a vehicle that you're using for business, for the most part, vehicles are treated a little bit separately from the rest of your tangible capital assets. They are in their own classification of 10.1. And so it used to be for years, no matter what you paid for the vehicle, or I shouldn't say no matter what you paid, if you paid more than $30,000 for the vehicle, you would only be able to depreciate using the depreciation rates based on $30,000. So if you paid 50 grand for a vehicle, wouldn't matter. Your depreciation expense would be based on $30,000 ceiling multiplied by the 30% depreciation rate. So in the last couple of years, they've started increasing that amount. And for 2024, it's gone up to $37,000 from last year's 36, which it's only been the last couple of years that that's been increasing significantly. And then there's a separate classification for zero emission vehicles. So if your vehicle is an EV, then the cap is much higher, recognizing that the cost for those vehicles are generally a bit more than traditional combustion engines. And so that one, it got recently bumped up to 61,000, and it's staying that way for 2024. A quick comment on the vehicles thing. So if your vehicle is being used to move product, transport things within your business, you don't have to fall within these limits. So if you have a vehicle that is for transportation of supplies or people in terms of your operations, then yes. But if the vehicle is for, let's say, management and sales staff getting to meetings, administrative folks getting to meetings, like just getting a person having a vehicle just to get them from A to B to conduct business, then those vehicles would be depreciated individually through this program. But let's say you have vehicles that's solely responsible for delivering parts and supplies throughout the city, then those vehicles can be pooled in the traditional way. Another really welcomed increase is the amount that you can deduct for leases. So if you are leasing the vehicle instead of purchasing them, so if you purchase the vehicle, you would depreciate it. If you have leased the vehicle, then you can deduct the lease payment against your taxable income. And there are caps on how much you can deduct. And this all falls under the concept of reasonable expenses under the Income Tax Act. So in order to provide some guidance around what is a reasonable expense, some of these limits are introduced or are defined and maintained. So for the longest time, leases used to be, I think it was around $900, maybe $850, and it's been going up. And so for 2024, it's $1,050 per month before taxes. So this is definitely good news because vehicles are getting more expensive. So now, if whatever your lease payment is, you can deduct up to $1,050 of it. If your lease payment is $800 a month, then only the $800. But if it's $1,300, you're capped at the $1,050. And the last one on the screen is interest costs. So if you did purchase that vehicle and you're financing it, this one finally got an increase. It didn't make the cut for increases in the last year or two. If you are incurring interest charges on the vehicle that you have financed, the most that you can deduct is $300 a month in interest costs, which isn't a lot. And so now that's moving up to $350 for 2024. A couple other important things for vehicles. I'm just going to check for questions really quick. Yeah, if we had a zero emission vehicle that we purchased privately but is being primarily used for business, does the corporation have to purchase the vehicle for it to be fully capitalized? Okay, so that's a good question. I might need a bit more info. So the new rates are for vehicles purchased and acquired as of January 1st, 2024. So if you purchased the vehicle before that, you'd be subject to last year's rates or whatever the rate was in that given year. So if the bigger part of this question, though, is if you've purchased it personally and privately and you already do have a corporation, for your corporation to be able to depreciate and get the depreciation expense, the corp has to own it. So that would mean that the corporation would have to buy the vehicle from you, the owner, and that has some implications. If your business is already running and exists, then you may be subject to paying the PST on the vehicle again. So you would have paid PST when you purchased the vehicle initially, and then the corporation buying the vehicle from you, when you go to register the insurance on the vehicle in the company's name, MPI will collect PST from you again. You can explore with the Manitoba taxation branch around how to potentially get around that. There are some mechanisms to do that, but generally, if the corp was just created in the last 6 months, sometimes they're picky about that. So check with your tax accountant. Usually what I do is I always run the situation by the Manitoba tax office on every unique one just to get their pre-approval. And then we do what's called a rollover and to roll the asset, the vehicle into the corporation. That's really the biggest implication, is not having to pay the PST again. But the vehicle does have to be owned by the corp for you to be able to capitalize and deduct the depreciation. Now, if you don't do that, what I often do with clients is I'll say, okay, if you own the vehicle privately, but you're using the vehicle for business purposes for your corp, just have the corporation reimburse you for mileage. Depending on how many kilometers you're putting on the vehicle, that actually can be better, because the mileage rates aren't bad. And that's what's on the screen right now. You can pay yourself and you can reimburse an employee, and this works for you as a shareholder. If you are a working shareholder, you can reimburse yourself for mileage. And as long as you are using the reasonable rates that are set by CRA each year, what you're getting reimbursed is not going to be considered taxable for you in your hands, but it will be an expense for your corp. So that's quite tax advantageous. The best combination is when an expense is deductible for a corporation and not taxable for the individual recipient. That's the best combo ever. So if you are doing something like that, the limits on the screen here, and then these have gone up a little bit, and they generally go up a little bit every year just to keep up with inflation. So the first 5,000 kilometers, you can reimburse yourself up to 70 cents per kilometer. Anything over and above 5,000, it's 64 cents. So that is quite handy. And that might be better than the vehicle being moved into the corp, because the other thing that you would have to do if your corporation owns the vehicle, you'd have to keep track of your personal kilometers. So if the corporation owns the vehicle, and let's say you put 10,000 kilometers on the vehicle total for the year, but only 8,000 of those kilometers was for business purposes, the 2,000 that you drove personally, you would have to report a taxable benefit for you on your T4, and that's the second bullet on the screen. And though that would be at a rate of 33 cents per kilometer for the operating benefit. And then there's a separate calculation for the benefit of just having access to a company vehicle. So it's important to have this conversation with your accountant around what's the best structure from a tax perspective. Generally, if you're driving the vehicle for more than 50% of the time for business purposes, I generally do recommend having the vehicle in the name of the company because it saves you personal cash flow. But if it's around that mark or below, definitely don't have the company own the vehicle, because you would get killed on the taxable benefit of the vehicle.
Can I ask that question? So could I just do a follow-up question? That's
Sure.
super
Yeah.
super helpful for that. What if in the corporation we aren't really paying a salary yet because it's a startup, and we're mostly relying on shareholder loan as the capital infusion on that? What do you do for the taxable benefit on that portion for the mileage? Because we wouldn't be issuing a T4 for, say, last year because we didn't pay salary to the individual.
You would have to, so if the company owns the vehicle and you're using it personally, is that what you're asking? Like what you would do?
No, we own it privately. And so, yeah, I was just inquiring about if we switched it to the corporation owning it. But right now we are tracking the mileage, so we could do the mileage reimbursement to the shareholder loan. But the back part of that question is we're not doing a salary because it's mostly just shareholder infusion versus like a salary component.
Sure.
So just the question on that piece.
Yeah, so if you are using the reasonable rates, like the 70 cents and the 64 that you see on the screen, there is no tax implication to you. So you wouldn't need to file a T4 or anything like that, because what you're being reimbursed is considered reasonable, and it would be non-taxable in your hands. And it would still be an expense for the company. So if you're not going to actually pay yourself the cash, you would book the expense and then credit, like put the offset to your shareholder loan, showing that this is money that the company owes you. If you reimburse yourself above those rates, then even if you don't take salary in T4 yourself, you have to file a T4. You can do it through a T4A. So if you don't use like a traditional payroll system, you can file a T4A and report the taxable vehicle benefit on there.
Got it. Okay, thanks a
Yeah,
lot. Super
yeah,
helpful.
you bet. For sure. Awesome questions. Another goodie to always talk about and look at is what's going on with our tax tiers. So we saw a big increase for the 2022 tax year, and now for 2023 we see actually another significant increase, which is fantastic. So the tax tiers have all moved up by about $5,000 each. So the first tax tier of your first 0 to $56,000 of income is 15%. Now these are just the federal rates. Manitoba's, I think, moved a bit, but not as much as the feds. And our tax tiers are different, right? We have fewer. The feds have 5. So just looking at the federal side, this is really great because that means that $5,600, about $6,000 of income is now within, more of it is within that lower tax tier, which is definitely really handy from a tax perspective. So this is important from a tax planning consideration because depending on your balance between wages that you might be taking from the business and or dividends, updates to these tax tiers might make it more beneficial to take maybe some salary, more of a salary versus a dividend, or vice versa. So it's important to revisit these, at least ask your tax professional about it, or sit down and give some thought as to what your tax bill would look like given these new tax tiers. But definitely nice to see an expansion of the lower tax tier, and then obviously then the following ones, right? So the 20.5% now has a higher cap at the 111 versus the 106 or 107 that it was before, and so on. So some good increases there. Here's a new one that might bring up some questions. So we have changes to the CPP program. I'm just going to pop up the screen again here. So changes to the CPP program, not so much changes, but more so, I guess, enhancements. So the Canada Pension Plan, and this is really important for whether you're a sole proprietor or a corporation, you folks pay twice as much as someone who works as an employee, because any employee would have to pay or contribute the 5.95% of their wages to CPP. But if you are sole proprietor or if you're incorporated, then effectively, since you are the company, you have to do the match, right? So CPP is a little bit more of an expensive venture for you. So 11.9% effectively. So the maximum has gone up a little bit. Again, it goes up every year. That one's definitely been always indexed to inflation for quite some time. So the yearly maximum is $68,500. The basic exemption is still there at $3,500. So the first $3,500 of income is exempt. So this year, the combined cost for self-employed would be $77.35. Based on that first tier of 68,500. So an increase there. Now, what has changed is the government has introduced a second enhancement, the second part of the enhancement to CPP. So a second tier has been added to CPP contributions. So what this means is there's a second ceiling. So the second ceiling for 2024 is 73,200. So if you have wages that are above the 68,500, which would have been the traditional cap, anything over and above that 68.5, the contribution is 4% of those wages up to the 73,200. So that difference of 15 was that $4,700, about $5,000. There's an extra 4% cost on CPP contributions there, plus the employer must match the 4%. So the enhancement is intended to enhance the benefits that are being paid out to CPP and to fund those enhancements, and that is the additional cost. Similar to how when this was enhanced last time, the enhanced portion is a deduction now for individuals rather than a tax credit. So deductions are better than tax credits. So that part is okay, but this is definitely an added cost that should be planned for and incorporated when you're doing your income planning and how much to take in terms of salary versus dividends. So what we generally do from a tax planning perspective is we typically keep working shareholders below the 68.5. Sometimes some people don't take any. So what I generally say, what I start with as a conversation with the client is saying, you know, how important is it for you to pay into CPP? And everybody kind of feels differently about this, which is fine. And so if it's really important to you as an individual to pay into CPP, because remember, if an individual becomes critically hurt, CPP can turn into a disability benefit as soon as that disability status is granted. If you don't pay into CPP, you don't get that. So for individuals that say, I don't want to pay into CPP, I think it's too expensive, I don't like it, I'll do my own retirement planning. Fine. Make sure, I always strongly recommend, make sure that you have a disability insurance program in place, just to plan. We don't like to think about those things, but it is unfortunately the reality. For individuals that want a good balance, we do still typically stay within below the yearly max of the first level, the 68.5, and then for those working shareholders that want to take out more income over and above the 68.5, then the rest would be dividends. Just to get a bit of an optimal combination. Given the new tax tiers, I think right now in Manitoba, the optimal salary to take, if you want to be, taking that 68.5, 70, 90, whatever it is, I'd still stick to about 45,000 a salary to still contribute to CPP and have some contributions going. That's a decent tax rate. And then the rest as dividends, because dividends are taxed more favorably than employment income. And there is no CPP component to dividends. So if you take dividend income from your company, there's no CPP on that. The downside is that if you do take dividends from your company, it's not considered earned income, which means that it won't build up RSP contribution limits for you. So that's another reason why it's good to have a mix between salaries and dividends, because the salaries will give you contribution room every year, where the dividends won't. And as self-employed folks, you don't have a pension, relying on the CPP solely to fund your retirement, may not be sufficient. So having a retirement plan that includes RSPs as part of your portfolio is generally a good idea. Any questions about the CPP enhancements and the maxes? It's not on here either, but the EI maximum contributions has gone up a little bit as well. I think about $100 or so. So make sure that when you're doing your costing and your planning for staff, the staff that you have, you incorporate that, and whatever EI is gone up by, the match for you as an employer is 1.4. So $100 increase means $140 increase to you per employee, if they're at that max contribution. A couple other tax credits, the deductions that would be good to know. So for anyone that is in the business of tradespeople, apprentices, employees working in construction, there is a ability to deduct meals and lodging expenses that were paid so that you can earn that employment income at a temporary work location. This is quite handy, because deductions are the best. Anything that can lower your taxable income means that you just avoid that tax altogether. A tax credit lowers your taxes payable. So a tax credits, while they're great, I mean, they're better than nothing, it reduces the amount of tax that you owe. But if you can deduct if you can reduce your taxable income, then you don't owe any tax on that in the first place. So tax deductions are very valuable. So if you have staff or you're doing this kind of work, make sure that this is something that they know about. If this is the type of work that you do in your business and it qualifies for you, important to think about. I'll hit the last bullet here on the screen first, just because the middle one, it's not brand new, but it's important for people to know. The last one, home office expenses. So for the last couple of years, the government had a simplified method of home office expenses because of what happened with COVID. And to simplify the home office expense deduction for taxpayers, they offered a simple way of just saying, you know what, claim $2 per day that you worked at home for up to, I think it was 250 days per year. So that's now gone. So if you are doing, if you do have home office expenses, then you need to go back to doing the detailed method of providing the breakdown of those expenses and the space size of your home and all those kinds of things. Size of the office relative to the size of the home. Do we still need to enter the GST to only 2.5% for meals for construction work at a temporary location? That's a great, yes. So the deduction would be on the base cost of the meal itself. GST will still follow the same rules, the fact that meals are 50% deductible. So that labor mobility deduction is kind of unique and separate from the whole GST input tax credit system. So the base cost you'd be able to deduct, but the GST rules implications are still the same. The last piece on this slide is the changes to residential property, the principal residence exemption. So this is definitely a big one. So for many, many years in Canada, we enjoyed a lot of simplicity around the capital gains associated with selling our homes. That was our personal or primary residence. So to deal with the individuals who were flipping homes and calling them their principal residence in order to escape capital gains tax, the government started at the beginning of last year changes. For the last couple of years, they started requiring you to disclose the sale of your principal residence altogether. Even though there's no tax, they wanted to know about what you sold it for, what you originally bought it for, to at least disclose that. Now, some of the changes are where any kind of residential property being sold is going to be subject to full taxation unless, like if it was owned for less than 12 months. So if you've purchased a home to live in primarily as your principal residence, but you only live there for 7 months, and you experience capital gains, there is no option to claim the personal residence exemption unless you meet some of the exemption criterias, such as death, breakdown of marriage or common law partnership, relocation for work, or other life events. So, and I kind of, I'm a little about those criteria because it is still a fair bit subjective. So it would require the taxpayer to disclose what the exception event is or was for Revenue Canada to decide. So this is quite new. I haven't read up on what has happened with someone who's been challenged, or because there's just not enough data out yet. So it'll be interesting to see how that evolves. But the important thing to know is that if you've owned a home for less than 12 months, there will be capital gains on it, regardless if it was your principal residence. If you are flipping property, like if you're doing the investment and purchasing a property to renovate and sell it, that is business income, right? If your intention is to purchase that property in order to improve it and sell it at a higher cost, that is business income. That is not capital gains. So that's a big implication because capital gains are only taxed, only half of your gain is included in income. So whereas business income, the entire gain is included in your income. So that is a big implication. What about those traveling nurses and healthcare workers? Can they claim meals at 100%? So the way it's worded is tradespeople, apprentices, and employees working in construction. So I don't think that healthcare workers would qualify under that deduction. If they were maybe doing it as part of their practicum and apprenticing, maybe, but I think the whole point of the target market of that deduction is for the trades folks and construction staff. Or construction type of jobs employees. Okay, great questions. Any other questions so far before I go on again? Okay. A couple other important tax planning considerations. So just as there were increases or widening of the tax tiers, there was an increase to the basic personal amount. So you get a basic personal amount that is essentially income that's exempt from tax. So that's been increased to $15,000. So what that essentially means is that our first $15,000 of income, there's no taxes on it. So what would happen is if you earn $15,000, you would have taxes payable of 15,000 times 15%, that first tax tier. And then you would get a tax credit for 15% of $15,000, which then that would bring your taxes payable to zero. So this is an increase. It's gone up a fair bit in the last couple of years, and the goal was to get it to 15,000, and now the government's reached that goal. A couple other important limit increases. So the tax-free savings account, great to see another increase. So the contribution limit has increased to $7,000 for the year. It was $6,500 the year before, and it's been kind of climbing steadily. It's been with 6,000, 5,500, 5,000, and so on. So nice to see that increase. So right now, if you were at least 18 years old from when the program first started, then you could potentially have $88,000 of available room for 2023 and $95,000 of available room to contribute to TFSA for 2024. So for those that are unfamiliar, a tax-free savings account is the best place to put your money from an investment perspective, because whatever your funds grow by while it's in that account is not subject to tax. So let's say you put dollars into that investment account and you buy a GIC for 5%. GIC is interest income, which is the worst kind of income to have. There would be no tax implication on that income if it's earned within the TFSA. So if you are putting money away, that's where I generally recommend people put it first to get to use up that very, very valuable limit. A couple of critical thoughts on that program over the last year. We've seen some examples of Revenue Canada challenging taxpayers on the use of that account. So I think there was one case where one person, a taxpayer, day traded so much out of that tax-free savings account that they made like, I think it was around $400,000 or $500,000 of investment income. Revenue Canada deemed that he was running a business and denied the tax-free status of those gains and assessed it as taxable income. So it's meant for savings. It's not meant to escape taxes from doing business activities, because the guy was clearly day trading. The other important increase in limit is RSPs. So the RSP contribution limit has gone up to $32,490 for 2024. So RSP contribution limits is 18% of what you earned in the prior year, up to a maximum of those limits. If you don't use it up, it doesn't go away. The limit rolls over to the next year. So it's important to mention because, like I said earlier, as self-employeds, you don't have a pension. So an RSP program is an important element of your retirement savings plans. Okay, and one of the last things I wanted to talk about was the new Canada Dental benefit, somewhat new. We've heard a little bit about it recently because it's being extended to seniors, and everyone's really excited about that, which is really great because if you don't have dental coverage, then the federal government will now start to cover those things, and it's being staged. They started with kids under the age of 12, and then now being extended to seniors. And the reason that, and there's a fair bit of information on the screen, but the reason I wanted to bring it up today and talk about it is because if you do have staff, make sure that, because right now is the time to file for T4s. Right now is that time to file and report those T4s and provide them to Revenue Canada. You have to disclose on the T4 reporting process if you provide dental coverage or dental benefits to your employees. So there's new special coding that will describe whether the individual, your employee on the that's receiving the T4 has no benefit coverage with you, or has individually, or for family. There's about 5 different codes. So it's really important to start watching for that, because now that this program exists, it's an income tested program, and it's also a program that is based on whether the individual has coverage elsewhere or not, because while it is a dental coverage from the federal government, it is a coverage sourced from last resort. So they need to know who has coverage or not, and that's the reporting mechanism to do that. So if you're using a payroll provider, they may be asking you these questions and this information about your staff. If you're running the payroll yourself, it's an extra box and fields to complete per individual. Any questions about that or that program? Okay. Then we generally leave about 5 minutes for any Q&A at the end for any kind of general tax type of questions or things that have come up, whether it's from the slides or I can do my best to answer other elements. I will, while people kind of give that some thought, I'm just going to try and double check that question around the existing owners on the SBVCTC program. So eligible investor. Has to be doing investing in common shares, must have been issued before expiry of the program approval. Investor has to be an accredited investor or signed on a risk acknowledgement of risk form. That's pretty standard. Specified shareholders. So for the purpose of the program means a shareholder of a corporation that owns directly or indirectly at any time of the year, 35% or more of the shares of any class of the stock. So you can, as an existing owner, participate in the program as long as you don't own more than 35%. That's the limit. Question, can we have the contact details of Peter? Oh, yeah, WTC can, your WTC rep person can provide that. My contact info, it is, we'll come back to that. Here it is. It's at the end of the slides. The one that I was parked on was just, I'll let Eric do that, just about the business planning program. But yeah, there's my contact information at the end of the slides. Does a staff qualify for the dental programs if they are still on probation? Yeah, like the individual's qualification criteria for the dental program with the federal government has nothing to do with their employment status with you, just whether they have benefits or not. So if they currently do not have benefits, then I would put a no. I would say though, this is a bit of a gray area, right? Because if they don't have benefits because they're on probation, but they will, I would still probably put no for 2023 if that's the current status now. But then when you do the T4 for the next year, you'd want to update that code. I shouldn't miss any details.
Okay.
Yeah.
I think, yeah, so we're opening up for questions here. So if you guys want to unmute or put your mics on.
May I ask a question here?
Yes, of
Yep.
course.
Yeah, I can't chat. I can't, like, it seems like my chat is disabled for some reason. I cannot type it there. But my question is, yeah, if I'm not mistaken, did I understand it well that CPP is something that we can, as a self-employed or like as my husband has a corporation, can he opt out from the CPP and not to pay? No, we can't.
If you
Like
pay
a change
wages,
order.
if you pay wages to yourself, there is no way to elect out of CPP unless you are over a certain age and file an exemption form. So you have to be over 60 or 65, I think it is. And there's criteria on that, but generally, no, if you're working age, you can't elect out of CPP if you pay wages. If you pay yourself a dividend, then there's no CPP on dividend income.
Oh, okay. Okay. So in his case, he is paying himself a wage. So he would do CPP, and if he wants to do RRSP, so it will be like additional amount going from his salary.
RSPs, you mean?
Yeah.
So if he wants to contribute to RSPs, he can, because when you pay yourself wages, then you have your wages will give you contribution room for RSPs, and contributions to RSPs lowers your taxable income and saves you on taxes today.
Okay.
Yes.
Okay, good. Thank you.
Yeah. There was a question, if I've launched my business and I'm still in the research phase or have been in that phase for the past 2 years, is it advisable to file for taxes even though I haven't started making any profit and I'm eligible for any research rebates? Okay, so that's a really good question. So if you are doing research and development, starting your business and launching, there is, I'll just put the contact up on the screen here. If you are doing your business and launching, it is valuable to stay as a sole proprietor for as long as you can, because if you have valid, legitimate business expenses, you will essentially have a business loss, and that loss can be used to offset other income that you may be earning as an individual. If you incorporate too fast, those losses would belong to your corporation, and the corp will enjoy the benefit of those losses when it eventually has profit, because then the losses can offset the profit. But let's say you launch you incorporate the corp has losses, and then you eventually, say the business is not working, got to close it, those losses are lost forever. So there are many grant programs and tax credits are still available to sole proprietors. You don't have to be incorporated to qualify for a number of them. So you don't incorporate too quickly. And I think for more specifics, to be important for you to review that with your tax accountant, your tax professional, to look at that timing. But that's generally my stance with our startups, is don't incorporate too fast. Incorporate is a must when your business activities are earning you more money than you need to spend on your day-to-day life, right? Then the tax benefits of incorporating are absolutely there, aside from the legal liability benefits for sure. But from a tax perspective, when your business activities are earning you more money than what you need to spend in a given year, then yes, corps are a great tax deferral strategy.
Okay, awesome. Okay, so we're just over time here. We'll wrap up today's session. So on just before the slide, the last slide here, we also have our business planning program coming up this April. So April 9th is a 7-week virtual program. And it's led by our expert, and Peter is one of our experts. So Peter and Sherry and Rosalie. So check that out, scan that QR code. If you want more information, you can also book a consultation with myself and Paul, also business advisor at WTC. But we'll close off today's session here. Again, thanks, Peter, and thanks everyone for attending this session here. And I wish you all a good afternoon.